Welcome to the monthly preferred CFO webinar class. My name is Scott Crawford. I'm a partner at Preferred CFO. Tara Christman will be our admin for today. Today's topic is, what is financial forecasting and planning? It will be presented by a member of the Preferred CFO team, Mr. Michael Paulsin. Michael Paulsin is a highly regarded financial leader with over 30 years of organizational and financial expertise in a variety of economic landscapes in both public and privately held companies. He also has a pretty wicked sense of humor.
Hmm.
As you have questions, please use the Q&A button first. You'll notice at the bottom of your screen, there's a Q&A button, there's a chat button. Tara will monitor and consolidate these questions. Mike may hold some of those towards the end, or we may insert those at various points during the webinar. We will be certainly less than 60 minutes, probably less than 45 minutes is our goal. If you have specific questions about how the topics today apply to you, we are more than happy to give you some pro bono one-on-one time. And you can either set that request, say, I would like to be able to have a private meeting. You can either send that through the Q&A, or you can also send that through chat. And there's no obligation for that. Again, our goal is to be able to share this information with you, give you the tools and understanding to be able to DIY it. And if you have questions about how it applies to you or how to implement it, again, we're here to be able to help you with that. Again, there's no cost for these monthly web classes. They are offered as part of Preferred CFOs Association with Vistage. So with that introduction, I'm going to turn the time over to Mr. Mike Paulsin.
Thank you, Scott. Thank you, Tara. Hello, everyone. My name is Mike Paulsin. The topic today is purpose of planning and forecasting, and just a little background. I grew up in the financial side of the business with all the different titles: accounting manager, controller, CFO. Then I moved into general management leadership and had titles like president, COO, CEO. So when I think about planning and forecasting, regardless of what hat I wore, it was just a very, very, very important part of running the business. And so whether you're sitting there in a financial role or in an owner role or in some other role, I'm going to try to come at this, from kind of equal perspectives, depending on the hat you're wearing. And I'm going to start just with, I'm going to get with a brief questions that, and you could probably add to this. But here are some questions that come up, all the time. Are we operating profitably as a company? We see our closed numbers. Do we understand them, et cetera, et cetera? Where should we put our resources? Can we afford to expand or invest? Do we really understand our cost structure? Do we understand our variable costs versus our managed costs? And I use managed costs instead of fixed costs because I really don't believe anything is fixed. It's just over what period of time does it vary? Do you know what your margins are? Your break-even levels? Do you know where you are over or under spending? Are you priced right in the marketplace? Do your people know what the plan is? I hate that. We don't know what's going on around here. Do you anticipate changes in the marketplace? When a competitor comes into your area or a competitor leaves or something, now interest rates are moving around, there's tariffs. Do you think about these things? Do you anticipate them? Do you have a mechanism in place that tells you quickly with confidence, what you should do if these things were to happen, or any scenario of what ifs? So, wearing all my hats that I've worn in my career, in overview, if I had to end the presentation right now, I would say the purpose of and the benefits of planning and forecasting is that it helps me think. And it helps me learn. And it helps me not to take anything for granted that it will continue the way it is. It forces me to think And when I do that, again, having experiences in a bunch of different roles, not always, but most of the time, it's helped me make better decisions, faster decisions. And one of the less obvious benefits to doing this, Scott and I were just talking about this, is that when I am able to do that, when I'm able to think, make better decisions, act more confidently, it makes me a better leader, a better general manager, a better CFO. And in today's marketplace for labor, where it's so hard to recruit and maintain really quality people, most people I think I've borrowed these phrases from others over my career. Most people, want to work for someone that has a vision or a company that's looking out past today. And if they're not that forward looking, everybody generally in a company wants to know basically two things. What's the plan and how can I help? And so one of the less obvious benefits of having a good planning and forecasting in your company is that it helps to build culture, retain great people, because it improves communication in the company. What is a financial budget? I've been working with in this fractional CFO role for about 4 or 5 years now, and one of the places I start is like I come in and I say I'd like to see your plan, and I generally get a 1 or 2 page spreadsheet that's an income statement, and it'll show current year and next year, and it's very little detail. And I'm like, great. Um, and then as I start to work with the team, uh, uh, besides the financial person or the owner, and I start to get involved with their meetings or start to do some stuff offline, uh, the I'll ask a question. Well, are you on budget? And the person goes, I don't know. I don't have a budget. I don't know what my budget is. Did you participate in making the budget? No. So I would encourage everybody, regardless if you're 10 people, 100 people, 100 employees, 1,000, to involve at least your key managers in the construction of your budget. Done right, it should involve more than just the CEO and the CFO. And the cadence I always try to use, and I'm going to use a calendar year for an example, was sometime in the late summer, early fall, we'd pull together as a team, probably a dozen of us, and we'd go off site and we'd sit and we'd kind of brainstorm 3 year goals. Where we want to be. Some top line goals, revenue, some bottom line goals, profits, and then we'd start to fill in the blanks a bit. Well, how much of that revenue will come from new products? How much of it will come from maybe geographic expansion to another state, county, country, whatever your business is? How much of it will come from some technological advantages we're gonna introduce over the next 3 years? And we didn't tick and tie everything. We weren't worried about it at that point. We were just kind of setting the landscape for some bigger goals. I've seen a lot of planning models, some they used to call BHOGs, big, hairy, audacious goals. And we'd always try to make those goals uh, meet 2 criteria, aggressive, but achievable. If you're going to throw a big number out there, if you're a $100 million company, you said next year we're going to be 300 million. Some of that could be demotivating unless there's an acquisition planned or something like that. But we'd start with a framework of some big goals that served as kind of the backdrop for what we'd want our annual operating plan for the next year to fit into. Once we did that, did a little team building at the same time, we'd go into the annual planning process. So let's say this year's 2025. We would start that 3 year kind of outlook in maybe August, September, agree on that landscape, And then we get into the 2026 planning process. And it'd start with revenue projecting. We involve the sales leaders, the marketing leaders. From there, we translate that down into volumes for our production areas, and we'd budget G&A to support the overall. And it was department by department, region by region, and that was very detail oriented. And by doing that, everybody was involved in it. Nothing was a surprise at the end of the day. So this last bullet, done right, it should involve more than just the CEO and CFO, depending on where you are in your company's maturity. The more you involve, the more ownership there is of the numbers. And guess what? Whether you have the CEO hat on, the CFO hat on, or a department manager hat on, you learn a ton by going through that process. It always amazed me how much I thought I knew to how much I really knew when I sat down and put my due diligence into doing that. And it was hard work, but it was fun at the same time. Now that's a budget. It starts kind of with some big goals. You narrow it down. You one time at the end of the year, you lock in your revenue in whatever format makes sense to you, by product, by region. You budget your costs in whatever structure your company operates in. The better your chart of accounts to accommodate that, the easier it makes it. And then you get into the year and you start operating. And this is where, at least in the short term, you start forecasting. So you close the first quarter, let's say. And now the question is, well, how did we do? Oh, we came up short, or we're killing it, or we're right on budget. But some things happened in the first quarter that you didn't anticipate. Maybe a couple key people left. Maybe you picked up a giant customer. Maybe one of your big machines went down and you need to, do something about that, big repairs or capital, whatever. You then combine your actual results, and now you have new data, and you don't throw out your budget, because a budget is a commitment that your organization made. You take the new information you learned through the first 90 days or 30 days or whatever your cadence is, and you reforecast the year. And you build in some of the external changes that you might have, not been able to anticipate when you put your budget together, as well as some internal changes that you now, it's the world's not static, it changes. You build those in and you forecast out the rest of the year, at least. In a perfect world, you'd always have a rolling 13-month forecast or 12-month forecast. That's a little harder mechanically, but if you don't have a place to start, you budget for the year based on your 3-year kind of big goals. And then after each close, you recast the year, and, you get good at that. Okay. For those of you that, I'm in my 60s. There's a lot of planning, organizational management models in the marketplace. But they all kind of follow what I would call the Deming cycle. Edward Deming, he goes back to the 1950s. He was an engineer of sorts, and he developed what was known then as the Plan, Do, Check, Act model. And it was more or less specific to engineering and process improvement. But the budgeting process, the forecasting process, to me has always been very much the same. You make a plan, which here is design or revised business process to improve results. You do the plan, so you run your business, you implement it, you check. Are you getting the results you want? You close your books, you look at it compared to your budget. If you like the results, you move forward, you keep doing your plan. If you don't like it, you decide, what do I need to do to change it? And so it's not a one and done kind of exercise, a budget, a forecast. It's as ongoing as closing the books, paying the bills, doing call reports. It is It is as important as any of those, if not more important, because it helps keep the train on the tracks, and it helps, you as leaders, make sure that you are doing what your job is, which is, reacting to changes in the marketplace, but doing it in a planful and thoughtful way. So if you have some time, you could research Edward Deming himself, but I believe this almost everything we see in the marketplace today is some variation of this, down to action plans of who does what, when they do it, weekly check-ins and all that. It to me, it's very similar to this. Now, the obvious benefits of having a great planning and forecasting um, process in place is that it really does build financial discipline and control. There's been many times in my career where, had I not built a budget almost from scratch, if an expense or revenue um, change happened to that, I wouldn't have noticed something that I needed to notice. So it does, help you with internal controls. It does help with identifying variances uh, uh, that if you didn't have the budget in place, it might have just got baked into your numbers, and you might have been wastefully spending money for many, many months going into the future. So the basics of financial discipline and controls are a very important product of the budgeting and forecasting cycle. And it really becomes important if you ever go to sell your business. One of the first things people ask, what's your forecast? What's your budget? If you don't have it, you're kind of starting that process with your foot in the hole. We've already talked about this a little bit. It does improve decision making because it helps you think. It makes you smarter. It allows you to act with more confidence, and that's really important to being a leader. And then again, if you have stockholders, key customers, investors, silent owners, any number of stakeholders in your business, when you can talk to them in very specific terms, here's our budget, here's our forecast for the year, here's why it changed from the last time we talked about it. They really know that the right people are running their business, and that can help in any number of ways. To possible selling one day, or you name it. We all know how important confidence is to running businesses and building relationships, and having a good budgeting process in place is critical to that in a business. Some of the not so obvious benefits. When you have a vigorous planning process, at least the annual one, for maybe your frontline folks, and then the 3-year look in the end of the summer for maybe your senior folks, really helps develop your people. One of the things we used to always do is that in the 3-year outlook, we'd walk in and we'd say, okay, everybody take off your functional hat, put on your CEO hat, and help us think, like 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 the CEO should think, and don't just be thinking about your group. All right, put your CEO hat on. It really helps develop them into broader thinkers. It improves accountability. When folks help build the budget, as they say, if you approve the numbers, if you had a stake in putting them together, we all know this. The CFOs on the phone, or controllers on this presentation, you go to sleep a little easier at night knowing that your frontline managers understand their budget and know that they meant something, that they put them in, that they were approved, and you're going to be reviewing the variances at the end of each month or quarter. I'm a big believer in culture. I think I don't know what is going on around here is a terrible thing for culture. But if the more folks that are building the plan, tying it to the goals, knowing exactly what the plan is, and like I said, what they can do to help, that helps build culture. It improves communication in your organization, so people do know what's going on. And again, to wear my CEO hat, not just my CFO hat, the better the communication, the more trustworthy your culture is. And in a very real way, when you have trust in your organization and you trust the people making decisions and you understand the plan, trust translates into speed. And I can't emphasize this enough, especially in the world changing. Speed is a competitive advantage. Bottom line, end of story. So to wrap up, this is my personal wrap up I put in here. And I look forward if any of you have any questions. I hope this is the timing of this is working for everybody. Planning and forecasting, I think not just for me, but for those of you that do this or that want to do more of it. The big takeaways for me are always it helps me think, helps me act confidently, and it helps me lead others, and run a good business. So with that, I will thank you all very much for attending and listening. And then if you have any questions, please send them out to Tara or Scott. And if you want to have a post follow up with our company, or with
Hey,
me or
Mike.
with others, we'd be happy to do so.
Mike, we
Yes,
did have a few questions come through.
sure.
The first one is, how do you know if you should or can raise your prices?
Well, that's a great question. Um, most depending on the industry you're in, but I'd say this is true almost in any industry. I think one of the fallacies is that your price should be based off your cost. Price is dictated by the market. Eventually you could do some things um, to maybe raise your prices temporarily while you're offering something that's similar to others, but eventually the marketplace is so efficient. The marketplace figures out, you know, if it's an apples to apples comparison, what you're selling is the same as what somebody else is selling. Um, Generally, the market's going to go towards, the lower cost, the lower price provider. Uh, the caveats to that would be, if the relationships are so strong, or if your service, if your service is better, or your credit, if you're offering something different. But if it's apples to apples, you know, the marketplace is going to dictate your prices. So how do you know when you can increase prices? You got to look at your competition. And if you're offering a better widget or a better service than they are, and you're underpriced, then you have an opportunity to raise your prices because what you are doing is better than what they are doing. Basing your prices solely off costs might be a good starting point to know, hey, especially if you're introducing something new and you're saying, hey, we're going to come out with this new product. Here's my direct costs, my material costs, my labor costs, my IT, whatever your costs that are there. And you say, I want to make a 30% margin on that or a 60% margin on that. And my price needs to be $100. And then you look at your competition and it says, hey, they're selling it for 60. You should pause and say, well, wait a minute. Do I have my costs right? How could they be doing it that way? So it's a great question, but I'm of the opinion, Tara, Scott, that pricing is based more on the marketplace and your value relative to your competitors. And if you're providing more value, you have more pricing leverage. If you don't, you have less. Your costs are just a starting point for that.
Hey,
Great.
Mike, I know you and I had a discussion a short time back about the what if game that forecasting allows you to play. So,
Right.
if you're uncertain about your price increase, you say, well, if I increase my prices by 10% and I lose, 3% of my clients because I'm not competitive, what would that outcome look like?
Yep.
And it just really impressed me, Mike, when that conversation you and I had that you said, well, you simply make those changes in your forecast. All right, I'm going to up my prices by 10%. That increases my margin, but I'm going to reduce my revenue, my total revenue by 3%. I may still coming out ahead if that
Yep.
situation happens.
Yeah. I mean, and that's, if you have that mechanism already in place, so you're not reinventing the wheel every time a decision comes like that comes up, and you know your margins, you know your selling price for your products, your direct cost for your products, and you see how elastic it is, and you make an assumption. If I, like to what Scott said, hey, what does it look like, if I reduce the price or increase the price by 5%, if I lose, 20% of my volume, and then you have to make, let's say in the short term you go, hey, I come out better on the bottom line. Now you have to think, well, long term though, is giving up the market share something I want to do? That would be what I would call making a well-informed decision if you thought about it that way. But clearly, knowing what your competitors do is a very critical element to that. Not just your cost to produce.
Great. And we had a follow-up question to that. It says, you mentioned that the marketplace is efficient. Does the current landscape with tariffs and global supply chain issues impact or reduce that efficiency?
Well, that's a great question. And I would say this goes back to why I don't ever say anything is a fixed cost, because everything is manageable and should vary over time. I think in the short run, it might create some opportunistic pricing opportunities for clients. Let's say you're importing something. Let's just say you brought 12 months of, I'm gonna throw out a hypothetical, 12 months of inventory for widget A from China, and you already have it in your inventory. And others don't have that much. And now tariffs go up and you have 12 months worth of sales where you didn't have to pay the tariff on it, right? Everybody else selling that maybe 2 months from now is going to have to raise their price if they didn't build their inventory too. So you might have some opportunity until that inventory situation rights itself to take advantage of, hey, I could charge higher prices because even though I bought it cheaper because I didn't have to pay tariffs, everybody else I'm competing with is going to have to raise their price. So I might as well at least go up to that for the time this inventory lasts, make hay while the sun shines. But then eventually the market does get efficient again, and it puts everybody on a more level playing field. Does that make sense?
I think so.
Yeah. Okay. I hope that answered who's ever asked that question. So it might lead to some opportunistic pricing changes for you, or it might lead to some pricing challenges you're going to have if those roles were reversed. If your competitor had a lot of inventory and they could keep their prices low and put you in a little bit of a cash crunch because you can't. See what I mean? So, but eventually the market gets pretty efficient and settles that out.
Great.
Hey, Mike, sorry, before Tara brings in another question, the action you have here in the middle, the act confidently. When you do your forecast, I know that's a part of the forecast process because when you get better at it, just by doing it again and again and again, you have an expectation about how your decision is going to play out, what the outcome is. Do you like to forecast in certainly an expected case, which would be the center line of that forecast, but also in a worst case or a best case scenario, so that you can say, yeah, this is, if we take this action, this is what we think the outcome will be. But here's kind of the borders, the good and the bad.
Well, I think that's a great question too, Scott. And I think again, if you have the mechanism in place to do some of those what ifs, worst case, best case, most likely case, is not too difficult. Probably when you get out of every quarter, you're probably worried about some customer, or you're probably excited about some customer or some opportunity. I like to call the baseline forecast. I like to call the main forecast the baseline forecast. It doesn't build any of your optimism in it too much. It is kind of based off trends. It doesn't build a lot of your pessimism in there either. But from the baseline, you can then say, hey, what if we did lose this customer that was 15% of our revenue at 30% gross margins? How would that change my forecast? Likewise, what if I picked up, you know, this this customer, or what if this new product line did better than I thought it was, you know, that I thought I had in my baseline forecast. What would the outlook look like? And clearly those are that that is real. Now you're getting really, really good. You've got a baseline. You could flip a coin. All things being equal, this is kind of how it's going to look. But then you can start doing those what ifs, Scott. To see what those what ifs how it would impact your forecast.
Excellent. Okay, so next question we have is, I am the COO at our company. How do I participate in the budgeting process? Should I ask the CFO or the CEO or both?
Yeah, I'd ask. I mean, it's um, you're the COO. My personal opinion would be, you should be integral to that. Now, COO titles mean different things. If you're COO and responsible for sales as well, yeah, you want to know what the revenue budget is going to be. And out of that will come your expected volumes that you need to build an organization to support. And to the extent you needed investment in capital, or new technology, or some key positions, absolutely. That would be, and so the short answer to your question is yes. Ask very confidently. I think it's the right thing to do.
Yeah, agreed. Great. Next question is, can variable expenses and managed or fixed expenses be assigned or separated within QuickBooks?
Uh, they can. Uh, that really is a chart of accounts decision. So if you build your chart of accounts the right way, so that when you pay your bills or make your payroll, those folks that are, you know, if you're running a manufacturing operations, and those folks on the front line, their payroll all goes to a GL code that is variable. All of the materials that you buy that are part of the end product go to variable. So no problem. They all get charged to those accounts, and then you see exactly, what your variable costs are. Then if you have other costs, a lot of companies have direct costs, managed costs, and then uh, um, they call them fixed. I call them indirect managed costs. And they take revenue minus direct cost to get gross margin, and gross margin minus indirect costs to get contribution margin, and contribution margin minus uh, fixed costs to get net income. But it's really a chart of accounts exercise. If you set your accounting system up correctly to separate those costs when they're recorded, then you surely can have those variable costs, those variable margins um, produced out of QuickBooks.
Excellent. Good to know.
Yep. Yep.
Okay, and then last question. This is a good one. How do I implement budgeting in my company? I am the CFO and the CEO is clueless about finances.
Well, oh boy, that's a good question. Uh, I think you have an honest conversation with him or her. Say, this is something you think would really be helpful. It would help you and the business run more effectively. It would help grow the value of the business. I would probably just, start having lunches and saying, hey, this is something, that's the right thing to do. And you're going to lead the charge. And all you ask is for his or her support, um, and help, and get at it. But clearly, the CEO or the owner, they get to make the decisions. Your job is to be straightforward, honest, professional with them. And if you think this is a shortcoming in the way the company is run and would benefit from it, you not only can ask them for their help and support, you have a responsibility with your title to go to them and say, this is what I think we should do. You are the chief financial officer, and that comes with the responsibility to shoot straight. So, good luck.
Great. I think that's all the questions we had.
All right.
So let me, I'll just maybe wrap up. If any of you would like more information, if you'd like some pro bono time with Mike Paulson or another member of our team, myself, um, Tara, whoever you'd like, if you'd like more information, I'm going to put into chat to everyone Tara's contact information or email. Please feel free to reach out to her and she can put you on his or my or one of our team members' schedules. And I think that wraps up. If you're still with us, let me share with you an interesting little story that I learned the other day. It came through the magic of AI and Chat GPT. I think the information was out there, but of course, now this becomes a great gathering point. But it really had to do with the power of forecasting. I think we're familiar with a ship called the Titanic. It's not a new story, but it's an older story. But there you go, Tara. Thank you for putting that into chat. Um, but spoiler alert, the Titanic sank. And the Titanic was considered to be an unsinkable ship. Well, one of the things that's come out recently through, again, the information available through just AI consolidation is that um, one of of course, the question is, why did the Titanic sink? Well, it hit an iceberg. Why did it hit the iceberg? Because it didn't alter course fast enough. Why did it not alter course fast enough? Because it didn't see the iceberg before it was too late. Again, the unsinkable ship. But the backstory to this is there was a second officer originally assigned by the name of David Blair. And David, just before the sailing, was replaced at second officer by an individual by the name of Frederick Fleet. So as David packed up his gear and left the ship before the sailing took place, he had with him in his pocket a key, a simple little key, and he took that off the ship. Well, what did the key go to? It went to a locker for the crow's nest. What was in the locker? Binoculars.
Huh.
The ship had binoculars that were locked up in a locker, but because it was an unsinkable ship, it apparently was not a terrible concern. They were sure they were, quote, bulletproof. But Frederick Fleet survived the disaster. And he would later insist that if binoculars had been available, the iceberg would have been spotted in enough time for the ship to take evasive action. They would have had, quote, enough time to get out of the way, Fleet maintained. The other part of that is we know the Titanic was owned by White Star Lines, which was owned by International Mercantile Marine. Well, International Mercantile Marine was backed by J.P. Morgan and was one of the very first companies that was considered to be too big to fail. But this disaster eroded investor confidence and it exposed that they had some financial difficulties, that they were really having a hard time making a profit despite owning so many transatlantic lines. And ultimately, International Mercantile Marine failed because of the light that was put on them by the Titanic disaster. So it all kind of boils back to what if the key had not been taken off the ship by David Blair? What if the Titanic had had binoculars? So, I mean, all as much as Titanic has become part of our culture and our reference point, there's a real story there for, I think, me and for all of us about the power to be able to see just a little bit further and a little bit further in our businesses. Because even if we think we're unsinkable or we're too big to fail, history has proven that that is really not always the case. So, Mike, unless you got any follow-ups there?
No, thank you, everybody. Scott, well said. That's a great example. We probably all have our stories about, man, if I only would have, done this or that or looked out a little bit, but it's a great process. The last thing I'd just add is, thank you again. And remember, this is not a one and done. This is a process. This is something that, that if you get in the habit of doing it, you're doing what you should do for your company. So with that, thank you all very much. Appreciate you attending this, and have a great rest of the day.
Thanks, Mike. Thanks, Tara.
Thanks, everyone. Okay, bye bye.